Hello, everyone. It is Colby, the DGI Crab, wishing you a happy 420 and a happy Easter Sunday. Funny how those two things always seem to come up on the same week, right? Whichever one or both that you're celebrating, or neither, I'm glad that you're here to discuss undervalued quality dividend growth stocks. For anyone who's new, I cover 60 high quality dividend growth stocks, and I am comparing the 4-year average yield to the current day yield to see if there are any bargains on that sweet, sweet passive income that we can go about acquiring here in the following week. However, where I'm going to differ from a lot of the other channels out there, what I believe makes this channel unique is that I have broken those 60 into 4 separate categories or tiers based on the age and time horizon of the investor, which I believe is the most important metric that a dividend growth stock investor should take into consideration. How much time do you have in the market? How many years do you have realistically until you have achieved financial freedom? And when you're not reinvesting those dividends anymore, where are those raises to your passive income going to come from? Well, right now, everyone, as far as the stocks that I've been excited about over the last couple of months, I'm underwater on a lot of them, and I'm absolutely loving it. It's giving me an opportunity on several of them to continue to dollar cost average down while those dividends continue to get increased year over year. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment purposes, and the expressions here are just this one crab's opinion. Now, this one crab strategy is as follows. I'm going to put 50% of my investment dollars each week into age-appropriate ETFs for automatic diversification. And as mentioned, I'm looking for stocks that are yielding 30% or more above their 4-year average yield. I have a list of my top 10 favorite stocks. 10 out of those 60 are just my arbitrary top 10. If any of those get to the 20% or more um, um, above their 4-year average yield, I go ahead and buy those regardless of age tier. I want to have good, strong positions in all 10 of those stocks by the time I've attained financial freedom. Now, I'm going to remain within my tier unless there's a stock in a different age tier that's yielding 50% or more above the 4-year average yield. We've still got a few of those, you guys, so you know I'm going to be sinking more money into those. And if I'm in my age tier at a given time and there's not any in that category that are in my undervalued zone, I'm just going to double down and add more to ETFs that particular week. I'm not going to try to time the market with my investment dollars. I'll just add more to the ETFs. So we're going to start out as we do each week with the Tier 1 stocks. So Tier 1, this is for the 18 to 30-year-old investor where we're looking for smaller starting average yield, admittedly, but very rapid annual dividend growth rate. We're usually talking about 1 to 2% yield on average, 10% plus annual dividend growth. Got these organized here by the valuation tab where I am comparing the 4-year average yield to the current day yield to see how far off that yield is. And if we've got stocks in the green, they're in my personal buy zone. Anything else is just a hold for me. And I do keep my dividends reinvesting across the board so I can continue to increase my positions in any of these stocks, even if I'm not actively adding money to them. I'll let those runners run all day. So Nike and Nordson, the two dogs in the tier 1 category, continue to be down. Their 4-year average yields do continue to gradually climb up week over week, and I do update these every single week before recording the video. So we've got the most up-to-date 4-year average yield going into the following week. United Health, all the way down here at 454. So United Health is an interesting case study for this strategy here, you guys, because what we've seen over the last few months is that United Health will dip down into my buy zone for a few days or maybe a week. It shoots back up into the yellow or even into the red zone here where I'm just holding, and then I stop investing in it, and then it falls back down, start investing, goes back up, pause. So this is sort of how you're doing it here. So hopefully your average price on United Health, especially if you just started buying it within the last 6 months or so, is a lot closer to $450 than it is to $500. Currently yielding 1.85% when the 4-year average is just 1.33%. That is 39% off the 4-year average. I am all about adding United Health while I can. And Analog Devices has been sort of popping in and out of the buy zone over the last few weeks. It's sitting here at 29.86% off of the 4-year average. I think 2.25 is just fine with me. I would consider this close enough to consider it a buy zone stock as well. And I would encourage any, and again, not investment advice, but I'd encourage anyone who's 30 or younger to add to their Microsoft position. It's 11% off the 4-year average yield, but it's just maybe the safest dividend growth stock that there is. Never a high yielder, really. You're probably not going to see it yielding even a full 1% very often. Here and there, maybe. I think it did that once in the last 2 years or so. That yield hit about 1%. I wish that I had bought more Microsoft at that point in time when it was there, because it wasn't there long. And if I could get that above the 4-year average yield, Microsoft is just so strong, I will just go ahead and add it at that point. So tier 2, age 31 to 41-year-old investors, starting yield is going to be a little bit higher, hopefully more in the 3% range when you are acquiring the stocks. And we're still looking for high single-digit year-over-year dividend growth, like 7 to 9%, hopefully. Target, way off the 4-year average, continues to be a screaming buy in my estimation. Target is just kind of losing the battle of the big box stores to Walmart and to Costco and let's see what else. It's Sam's Club. There's just quite a few that are just seem to be outdoing Target right now. Target seems to be constantly embroiled in political turmoil, which is, whether you want to say that that's of their own doing or not, is kind of beside the point. Every time I drive by a Target in my area of the country, always seems like they're pretty busy. Are they as busy as Walmart? Maybe, but they're not. If they're not as busy, they're within striking distance of being as busy. So I don't know what targets are looking like in your area, but Target has been increasing their dividends consecutively for 50 plus years. I think they're going to come out of this just fine. And while we're waiting for them to come out of this funk that they've been in, you get a 4.8% yield on your investment right now and get paid a lot to start out here. Just to wait. Hershey, I continue to be thrilled to just continue to gradually build up that position that I have in Hershey, which is knocking on the door of being a top 5 position for me now in terms of dollars invested, which is just amazing because I really had hardly invested any money into Hershey at all prior to 2025. And I just continue to add a little bit more money to it each and every week. Happy to do so, especially under $170. NextEra Energy, Starbucks, and Texas Instruments are all within my buy zone here as well. All fine choices. Texas Instruments payout ratio has been very high for a while now, so they are worrying me a little bit. To be honest with you, I'm keeping a close eye on them. I'm not saying they're going to cut their dividend necessarily, but the longer this payout ratio stays really high, the more concerned I'm going to be about it. So just keep your eye on Texas Instruments for right now. I'm going to still invest because this is the category that I'm in here for the next few months, but this is the one payout ratio of the 60 stocks here that gives me a little bit of pause. All right, so for tier 3, the age 42 to 53-year-old investors, here towards the end of the year, I'll be graduating into tier 3. It doesn't mean I'm going to sell my stocks in tier 1 and tier 2. I'll just more or less put those off to the side, not focus quite as much attention on those unless I get one like a Target or like a Nike or a Nordson that's 50% or more above the 4-year average yield. But this group of stocks, all these steady Eddie blue chippers, lots of dividend kings in here. 5 of my top 10 favorite stocks are actually in this tier: Pepsi, J&J, Procter & Gamble, Coca-Cola, and Exxon. And we've got 5 that are in the buy zone, including Pepsi, which would be my number 1 priority as a tier 3 investor. I think everybody across the board should feel great about investing in Pepsi right now when it's yielding 3.79% and a 4-year average of just 2.8%, almost a full percentage point of yield higher than what it typically does. Loving Pepsi at these prices. Hormel, T. Rowe Price, they've been beaten down for a while. Genuine Parts Company, I think, is going to continue to be negatively impacted by the tariff situation that's going on right now in the automotive parts space. A lot of these companies are going to have their problems with that, but I feel like Genuine Parts Company in particular could be vulnerable to that. We'll just have to wait and see. And then Archer Daniels Midland, yielding comfortably above 4%. I'm going to continue to gleefully add to Archer Daniels Midland while they are down. They're going to work their way out of this mess. They are a dividend king as well. So I am very confident that they are going to continue their year-over-year streak. And in the meantime, once again, getting paid very good yield to wait for them to recover. And Chevron, look out. Big oil here creeping closer to the buy zone. I wouldn't fault anyone buying Chevron if it's yielding right at about 5%. I'm going to be a little bit more patient than that and try to get it a little bit lower than that if I can, but Chevron's been trending down, so they're very much one I'm keeping an eye on. Tier 4, age 54 and older investors, we want to get a starting yield in the 5% plus range, if certainly, and we still want to get some dividend growth here. Don't throw it totally out the window. If we get 3 or 4% year over year dividend growth, we still want to be able to get that because any raise is better than no raise. And this group of stocks, we haven't gotten anything in that 30% or more undervalued for a very long time. Prudential, getting closer, still not quite there. I really love Prudential as a high yield stock. They do a pretty solid job of giving dividend increases year over year. Realty Income, I was happy to buy this one in my Roth IRA when it was yielding above 6%. It was on sale enough at that point, but they've recovered a little bit. It's that yield's fallen back down into the 5.5% range, and Essex Properties and NNN REIT, all three of these real estate investment trusts, all 10 to 15% undervalued, but not anything that makes me want to jump right out and purchase any of them right this moment. Everything else here, I'm just going to sit back and wait. Con Edison, by the way, really has been hot over the past couple of weeks. It is way up to $112 a share, only yielding 3%. How about that? All right, so my purchase strategy for the different tiers would look like this. If I'm in that 18 to 31-year-old tier 1 category, as I said, 50% of that money that I would have is going to go into ETFs each and every week. So my emphasis would be S&P 500 at 25%, small cap value at 15%, Vanguard Dividend Appreciation Fund at 5%, and VYMI, Vanguard International High Dividend Yield ETF at 5%. VYMI, by the way, is my only non-US stock holding, and I do VYMI all the way across the board, regardless of age tier. I just think it is far and away the best non-US ETF out there. Tier 2, same for different allocations, 25% into dividend appreciation, scaling back to 15 S&P 500 and 5 small cap. Tier 3, SCHD, VYM, DHS, all fine choices for a bit higher starting yield than VIG. SCHD's been the best of the three as far as the dividends have been concerned. VYM and DHS have both outdone it in share price appreciation. All have different strategies. I like all three. Tier 4, SPYD, top 80 highest yielding stocks of the S&P 500 is my primary allocation, and then alternative high yield investments that I haven't been investing in up to age 54, I'd start trickling some money into. SPHY for high yield bonds, PFFA for preferred shares, MLPX for MLPs, Devo, JEPQ, and SPY-I for covered call strategy ETFs. And then for my stock allocations, for the tier 1s, I'd hit Nike and Nordson first, trickle a little bit into ADI and Microsoft. This is going to cover me for the stuff in my own tier. And then I'm going to grab Pepsi, Target, Hershey, ADM, all the stocks that have hit either 50% or more undervalued, or in Pepsi's case, top 10 favorite in the buy zone. Tier 2, I'm going to hit Target harder than anything, get Hershey, Nextera, Starbucks, and Texan in my own tier, and grab Pepsi, ADM, Nike, and Nordson from the other tiers. Tier 3, Pepsi and ADM, Hormel, GPC, T-Row for my own tier, Target and Hershey and Nike would be my dip downs to get the undervalued stocks of the lower tiers. And then if I'm in tier 4, I'm going to do a 5% allocation this week into T. Rowe Price, yielding nearly 6%, but it's only because I'm not going to do an ETF double down and double down on my international investments. I'm going to double down on all of my ETFs, throw the extra 5% at the high yielding T Rowe Price. What are you guys buying this week? Let me know down in the comments below. I will see you next time.